limited losses. Similarly, the maximum loss for any bear call spread is also limited. It can be calculated in advance as the difference between the strike prices, which is the spread's maximum value minus the credit originally received. This is the limit to your loss, no matter how high the underlying stock increases in price. It will occur at expiration if the underlying stock closes above the higher strike price, with both the long and short options expiring in the money. So how do you profit from a bear call position? First of all, since you sold the spread in the first place, if you close out or buy back the spread before it expires for less than you received for it, your profit will be the difference. Say XYZ stock has decreased in price and you find these prices in the marketplace. XYZ June 60 call, $2. XYZ June 55 call, $4.50. We would like to thank you for taking the time to watch the videos that we have put together for you today. Take a look and subscribe to our YouTube channel, our Instagram, our Facebook page, and reach out if you have additional questions. We would love to hear from you. Check out our website for more information. Go to www.optiontradersnetwork.com. Thanks so much.